All right, welcome everyone to today's training. We're going to be going over how to leverage contracts and acquisitions. Now, this training is for anybody who's buying contracts, whether you're a cleaning company, CPA firm, bookkeeping firm, if you're an HVAC company, whatever the company is, buying contracts is a great asset to acquire and to stack into a holding company. And today we're going to be talking about different approaches to leverage contracts and why they're such a valuable asset for everyone's portfolio. And how do we leverage these contracts to generate additional income within our portfolio and use it to grow the holding company and the businesses in turn. So first things first, we got to recognize contracts aren't just about buying revenue. Like that's a big part of it, of course. Like as an asset, you're buying revenue, right? But you're also buying, in some cases, employees. You might be buying vehicles, assets that are also included. But at the core foundation, if you're just buying contracts, and if they come with employees, that's a plus. But even if the case, just contracts in general, like at their most fundamental basis, you're buying revenue. But you're also buying in most times built in for capacity, right? Employees, operational capacity. You're buying a proven performance. You know, there's performance built into every active contract. And you're also buying assets that can be stacked onto other deals. And so there's a lot of ways to really think about what we're buying here outside of just buying these clients or these contracts and the revenue comes with. There's a much more expansive view to look at these things. So first things first, before we go into how to leverage contracts, we got to go back to the basics. And the basics is being a business buyer versus a deal maker. And so in our teachings and our philosophy around doing deals, we always go back to this one contradiction between being a business buyer and a deal maker. So business buyers are typically people that are really focused on just going out and buying one business. You see this really often on social media where people are teaching just go on biz by sell, find a business for sale, go get an SBA loan, close on this business, and then run that business until you either just run it like a job and you operate it like a business owner, like an operator, and then you'll sell it in 5, 10 years, but you're mostly going from most people who operate as a business buyer, they come into the space as a employee or as ex corporate worker, and they just had a good salary, and so now they're going to invest that salary into buying a business. So typically, people come in with that mindset of I just want to buy a business. The issue with this mentality, though, is really similarly in real estate. For example, if you're in real estate and you're only thinking about buying a house, because you're just trying to buy a house, you're going to look at 5, 10 houses. You're going to look for everything to be perfect. Everything has to be the way you want it before you buy this business, right? Or this house. The reason for that is that you're operating more like a retail shopper, right? And we have thousands of people who enter the market every year who operate in the space like retail buyers. And there's a real issue with just being a business buyer. One is that you miss out on opportunities. What we teach, and the clients that we work with are operating more so as deal makers, as portfolio builders, people that don't just want to buy a business one time. They want to be in the business of buying businesses. So the way that we see this mentality is that you're in the business of buying businesses, which means in every business that you go into, you're looking for multiple ways to create value out of that business. A good way to think about this is that every business is just a collective of assets that come together to create this operational machine that generates income, right? So all these assets will come together. The products, the services, the IP, the marketing strategy, the sales strategy, the funnels you build, the employees, the customer list, the email newsletter that you establish, your social media accounts, everything comes together. All these assets, your equipment, your suppliers, your partnerships, all these things come together. They're all assets that can be leveraged. So when you go and buy a business, you're not just buying this business that's will generate income. You're buying something that is full of assets that you can leverage to generate additional income with. Sorry about that. And so you're buying the thing that you can leverage to generate additional income with. So every asset can be leveraged. A really good example of this is when we went into our business of when we bought a loan brokerage, it came with a database of 1,200 different past customers. And what we did was we leveraged this asset and we basically went through and we started providing bookkeeping services, starting to provide what wealth management services, um, M&A advisory, like all these different services that complemented where the businesses were already at. And so we're leveraging assets not just to grow the business of funding, but also to complement the other businesses in the portfolio, right? And so that's a point here too. We want to leverage assets to grow the equity value and exit at a multiple, at a higher multiple. This is really important. So when we're buying businesses, the goal isn't just to be operating it and to be running it. The goal of every deal that we do is to leverage the assets to maximize the equity value. The most important value that we can place on business is the equity value, the multiple at which you can exit at. Because there's two types of customers. There's the first customer that will buy your products in the business. You know, they're the ones that you serve, they're the ones that you built the business for. But the most important customer is who's going to buy the business after you. So all the work that we do wants to be to prepare your business for that ultimate customer. So we want to do all the work that we can on the front end to make sure that your business is attractive as possible for that customer. So we're going to fly through these just so we can touch on the strategies for contracts. But we want to operate more so as a chairman, right? So most of us come into business ownership as the owner. And a really good example of this is looking at Starbucks, right? So in Starbucks, there's the person who makes the coffee. They're focused more so on the operator work, right? Then there's the managers. These are people that hire the people that make the coffee. They build the systems, they focus on processes, etc. Then, of course, there are, most importantly, the chairman. And the chairman is the person who is overseeing the business. So they aren't working in the business. A really good example of this level is looking at like Warren Buffett. Warren Buffett, his whole job is to focus on doing joint ventures, allocating and managing the capital and profits of the business, looking for additional acquisitions, raising capital. The chairman focuses on all of the overall deal making aspects of the business. And so, as people who are buying businesses and we're acquiring companies, we're doing these different deals, we want to move to the chairman um, seat as quickly as possible. And so, as we're building out a holding company, you really want to be working with from this mentality at all times, and you want to fire yourself from this job here. Perfect. So this will be the last slide here. And the holdco is the vehicle that outlives any single business. So every holding company, so for example, when you're buying contracts, you're going to be buying the contracts through, typically, depending how you want to structure it, you could be buying them through an SPV. This way, it's in its own entity. So oftentimes, I've seen clients that will buy the contracts and then they'll put it in a separate LLC in case they ever want to sell them in the future. Other times, you can assume the contract into its existing operating company. So, for example, if you run um, Isolate CPA Firm LLC, you might be able to start a Isolate Contracts LLC and let that one be the one that takes over and holds those contracts in there. That way, if you ever want to exit those contracts, or maybe you want to add different contracts that you have into the entity and then sell them, that becomes a sellable asset. And so there's different strategies that we can do to look at this slide. There's different strategies we can do to mitigate risk, which is a really important structural advantage of doing a holding company. It helps you just outlive any single deal. And so there's a real structural advantages that reduces risk when we're doing the whole co strategy correctly. There's tax efficiency. I mean, we can offset losses, offset gains. It makes it easier to raise capital this way. Banks love the holding companies because if we separate the assets right, this is often better for financing. And holdcos often attract PE buyers, which exit at the highest multiple. Now we can look for strategic buyers too, but typically when we're operating from a holdco and we have multiple assets in business, we're going to be attracting more of a private equity buyer. This is the last point we'll talk about on this strategy here. So everything that we do though comes down to the wealth holdco. So we want to be buying our businesses, structuring them within the holding company, having our SPVs, our contracts, and the revenue that we're creating will be in the holdco. But then we want to have a wealth holdco. The most common example I see clients doing with this one is they will create, for example, well, first of all, looking at insurance policies. This is one that I always recommend having in the wealth holdco. Secondly, is like stocks and options for companies. So one of the most common things that I see clients doing is they will create stocks and options trading companies, and then they will allocate cash flow from the holdco into their own investing company, and then they will invest, just passively into ETFs, into different option strategies, whatever it might be. And if that money is even growing at 8% per year, 10% per year, and by the end of the time when you go to exit, you have an investment company of 500K making, 8% per year just passively, that's a whole asset that you get to exit. Now, asset management companies usually sell for 5x. And so it's a really great business model to do that, right? You're maximizing the overall equity value, right? So when you're operating as a chairman, you're not so focused on just only increasing the revenue of your business. There's all these different strategies that we can be leveraging within the holding company to maximize your exit on top of the work that you do in the business. So there's so many cool things that we get to do with this approach. But now we're gonna dive into contracts and how they're the foundation of just a good holdco and how we leverage them. And so, go here. Cool. Here we go. So contracts are proof of performance. So with every contract that we buy, there's an aspect of it that we get to leverage to generate additional contracts. Because of this, there's past history of performance. And so we're able to leverage contracts that we acquire to go out and get additional contracts by leveraging the past performance of these. Like it says here, even without a full customer list, every contract you hold is a case study waiting to be built. And some of the best joint ventures I've seen be made, some of the best new clients be onboarded I've seen have come when someone has just bought a book of business, and then they go out to similar companies in that book they just bought. They say, hey, we work with five. So a really good example, one of our clients, she bought a book of businesses for her CPA firm, and there were like five construction companies in that book. What she did, as soon as she bought that business, she came out with a whole campaign going after construction companies, just being like, hey, like we work with five of these clients already. We see that these are the common problems. We've been working with them for X amount of years, because that's how long they've been working with the past CPA. And so they leverage the asset that they just acquired to go out and get more customers that way. And so we really want to be looking at this as a strategy. Secondly, every contract you hold contains untapped revenue. There's so many different services that aren't being added. And so one of the best things that I see clients do, especially when they're buying a book of business, is actually meeting the people who are in that book. So if they're buying a book of business or they're buying contracts, they're relationship based work, and so you want to be able to say, hey, currently we are helping you with X, Y, and Z area, but do you guys need help with, for example, the floor waxing or our porter services, disinfection programs, right? So most acquirers massively underutilize what they've already owned. Within each existing contract, there are expansion opportunities that cost nothing to pursue. So this is a really big mindset shift, and it's really important. Going back to what we said before about thinking like a business buyer versus a deal maker. These are two different ways of looking at a business. And as deal makers, like we said before, we understand that these contracts are assets that we can leverage to create additional income. So yeah, we're buying the revenue from these contracts, but we also want to leverage them like chairman, like deal makers, to either A, get more contracts that we can acquire, going out to similar customer bases and taking on those clients as case studies, whatever it might be. So sometimes when you buy contracts, they will come with employees. And so the employees that come with a business are not a cost center, but they are an added benefit. So we get more employees added to our team. The biggest thing with this is just finding out the capacity of the current employees. And if they have more capacity, then we get, since they have merged into our holdco, we have the bandwidth to take on additional contracts without needing to hire anybody else. So this helps us win new contracts without having to worry about, how we're going to find help, etc. So you have no customer list. So you build your own deal flow machine. So this is a really important one that I want to touch on, and I'm gonna read it. So since the acquisition didn't include a customer list, you need to manufacture your own pipeline. Good thing is we already have the credibility to do so. And so we are buying the revenue of the contracts. And if they don't come with a customer list, that doesn't mean that we can't go out and get that customer list, right? And so a really good example here. So we recently took over servicing several facilities in the area, and we have extra crew capacity. We love what a quote you're building. Or remember, going back to being chairman and deal maker, everything that you need is already out there. We just got to make a deal to go and get it. And so one part of that is looking at additional acquisitions. We have the revenue coming in, so let's leverage this time to go out and look for other companies that we can acquire. Secondly is going to these companies to do joint ventures and partnerships, because these clients already work with the clients that we want to take on, right? So if we're a cleaning company, these are the clients that already have the quote unquote customer list. So now that we just took on these additional contracts, now that we have case studies, now that we have a larger team, now we have the ability to go out to these existing verticals and go structure deals to get access to their customer list. And we always, as a holding company, we have the option to acquire these. We have the option to do deals with them, to add them within our holdco. There's so many different strategies that we can do from a deal making standpoint, leveraging these contracts to get more customers in place. Next, the single biggest risk in a contract acquisition is losing what you bought. And so the first 60 to 90 days are really important. The most important thing is being able to really work on maintaining the relationship, right? And so we want to be able to introduce ourselves. We want to be able to over communicate, over just add value, continue adding the same value that they were getting before. We don't want to fix anything that doesn't need to be fixed, but we do want to add on to what the previous owner was doing. But the most important thing is just maintaining the same quality. From a deal structuring standpoint, there's different ways we can mitigate risk on this same topic. So that'll be a conversation for a different time. But retention on contracts, whether it's a book of business or contracts themselves, super important. Turn it into a platform play. So this goes back to a few slides ago. But now that we just bought these contracts, we do have the ability to go and find other companies that are looking to sell off their contracts and just say, hey, we just acquired these contracts. We have additional infrastructure and crews in place. We can absorb and acquire your contracts very quickly. Being able to say, hey, we just acquired this book of business. We're looking for additional books that we can acquire. We would love to talk more if you have interest in selling. So being able to just continue building the holdco off of this momentum is so important because every asset you acquire becomes leverage to acquire the next one. That is so important. Geography is margin, cluster your contracts and maximize profit. So in a service business, geography is your margin lever. The tighter your contract cluster, the higher your profit per dollar of revenue. So the most important thing about this is when we're buying contracts, we just want to make sure that it's in the same area. So for example, if you're buying contracts locally, that's a really big added plus. It'll help you just decrease your costs as well. So there's not going to be any increase in costs, anything like that that's going to affect your profit level on this acquisition, especially when it comes with employees. You just want to make sure that the the profit is being protected. And so just be careful if you're going to be buying contracts out of state. Make sure you have a way to protect the margins on those deals. And I guess one thing too here, if you do something where it's out of your region, we can do acquisitions, partnerships, joint ventures. There are strategies that we can go and do to still maximize that deal. And this is the most important thing that we're going to finish on. All that we do is to sell the business. Like your goal isn't to run the business forever. And this is so important for I think people to really realize and understand. Your goal is not to run the business forever because every business goes out of business eventually. You look at even the top Fortune 500 companies, all of them will eventually go out of business. It's just the nature of life. And so the goal isn't to be the best business operator and run your business as long as you can, and that's success. Like that is not success. The goal is to build your business and use it as a tool for wealth because the most important thing in this lifetime isn't, how big of a business you build, is the time and freedom that you have to spend it with your loved ones, to live the life that you want to live, and to have the freedom to retire when you want to. I mean, work's gonna always be there, right? But the exit, everything comes down to the exit. How can we build this business to sell? How can we build this business to be the most attractive as possible to the end buyer? And through a holding company and doing these strategies, I mean, it's a win when we follow the system correctly. And so everything we do with these contracts is to exit eventually. And so we want to do more deals. We want to leverage these contracts to grow the whole co because it's going to maximize your exit. And that's the most important thing. So kind of finishing up here, we don't want to just buy contracts, buy business, and call it a day. That's not what we're about. We are building a holding company that we will exit at some point. And it doesn't even need to be 3 to 5 years. I mean, it can be 10 years plus, right? The goal, though, is just that we are acquiring assets. A really good way, and if you're still listening, thank you so much. The last thing I'll leave you with is the holding company. A really good way to look at it is like a retail store. So in a retail store, you have all these different products on a shelf. And the goal of a retail store is to sell the products to the customers who walk into the store, right? With a holding company, that is your retail store. And the products on your shelf are all the assets that you own. So if you own Empire LLC Holdings, and that's your business, and within that holding company, you own like a cleaning company, you own a SPV full of contracts, you have a option trading company, you have maybe like a window cleaning company, like you have all these different verticals just in their own SPVs. Now, when buyers come, they can be like, hey, I want to buy this, I want to buy this, I want to buy that. Or actually, we want to buy the whole store, everything in it. And that's the way to see it, right? Like you are a collector of assets. You are building this whole code that has these assets on the shelf, and they help maximize and increase the value of the whole. So hopefully this was helpful. The biggest takeaway, guys, is just that contracts are meant to be leveraged to generate additional income. And if you're working on a deal that has contracts, please reach out to me and I'll be happy to take a look at it for you. Thank you so much.